Fintech Wednesday, where we welcome thought leaders and industry experts in finance and technology to share their insights, but also for all of you to network virtually. For today, we will have Ronit Ghose, and I will introduce you to Ronit to talk about the impact of COVID on financial services and on fintech. I wanted to start with the first part, which is the impact of COVID on the financial industry in general. And shall we start on the first question, which is, what are the main factors that will impact the financial industry?
Sure. We're obviously in the financial sector, like the broader economy, facing quite a shock. The financial sector is going into an economic crisis, an economic shock, but it's very different to the previous cycles that we've lived through. This cycle is very different to 2008 or 2010, so the global financial crisis or the sovereign crisis in Europe. Normally, when you have a financial crisis, you have like 2 or 3 years of bad debts, NPLs as we call them, going up. And then it takes another 3 or 4 years for a resolution. So when you have a financial crisis, you have like a period of maybe 5 to 7 years of stress. And in that period, banks generally are very internally focused. They're focused on balance sheet, they're focused on risk reduction. They're not focused on embracing change, or there's an increase in conservatism, there's an increase in focus on compliance. This time around, if all the predictions work out, what you're going to get is a very deep but relatively sharp shock to the financial system. And the financial system is very well prepared compared to 08 or 010 to cope with this. So sure, if you're a fintech right now and you're trying to work with a bank, things will be slow. You may not get immediate answers. You may not get projects signed off on quickly. It might seem frustrating from the outside if you're a fintech working with a bank, but actually, this next 6 to 12 months could be a really interesting period for banks on their digitization programs and for fintechs working with banks, if you have the sufficient runway. Because banks are going into this crisis and they'll have to, a lot of the mega trends that we had into the crisis are going to get accelerated. And that's what we're going to talk about in this next few minutes. So, if online payments are growing, online payments are going to, in the last couple of weeks, they've gone through the roof. If shifting people to your staff to remote working, that was already underway. It's obviously 90% of people in my department, or is it 95%, work remotely for the last 3-4 weeks. That has practical implications. It means that if you're relying purely on your proprietary systems, your systems are going to be reaching capacity. People are all those discussions about should we go to the cloud, how should we use the cloud? All of those discussions get accelerated dramatically. How do we use commercial real estate? How do we use physical space? So the first thing that happens in a crisis, and we've been in a crisis for the last few weeks as an economy, is first thing happens, you go defensive. You focus on conservatism. But actually, this crisis is going to be somewhat different to previous crises. It's going to really accelerate some of the existing underlying trends. And in some of the pictures and charts I shared with you, Hui, you'll see we can already see that happening in terms of how consumers, not just companies, but how consumers are reacting this time around on simple things like how we use cash and so on.
We have your slides, Ronit. So if Maria can show some of your slides, we do have the graphs that you wanted to share.
Cool. Yeah, so that chart that looks like a little bit like a heart monitor. What that chart shows you is the change in circulation of cash in the UK economy. So the bigger the amplitude, the bigger the demand for people, basically people going to ATMs and banks pulling out money. And the smaller the amplitude is, people are not going to their bank. They're not going to an ATM. So normally what happens in a crisis, so in the middle of the chart is 2008, the global financial crisis. So what happened in the global financial crisis is around Q3, but accelerating into Q4, people began to worry about the banking industry. So they would queue up outside bank branches in the UK and other countries, pull out money, go to ATMs, pull up. So there's a big spike. Similarly, in Y2K, when people were worried about money coming out of the system, so computers freezing, a lot of cash came out of the system. But if you look at this chart, those big bars are previous shocks. This time around, you can barely see in the bottom right-hand side, going into lockdown, if the UK had been in an economic and sort of financial and commercial structure like 20 years ago, you'd have all run to the bank to take money out. There's hardly any sign of that happen. It was same in France, same in a lot of European countries. There was hardly any increase. There was a little, very small increase. It differs though if you look at the US. If you look at the US or in India, I was looking at some data from India in an article yesterday online, and there's been a big spike in the amount of cash that people pulled out of banks in India. Even the ATMs ran out of money. A lot of cash was pulled out because people worried about going into this serious lockdown that the Modi government have had in India. E-commerce is cash on delivery usually in India. So people have stocked up on cash. In the US, the number of dollars in circulation has gone up, partly because the US is, the dollar is a global currency, so people use the dollar everywhere around the world. So the dollar is like this kind of, in a stress moment, people want dollars. And secondly, because the US is still in many ways less digital than Europe. The UK is much more on a day-to-day basis. The UK, parts of continental Europe are much more digital than the US. So in Europe, you've actually seen digital payments, digitization really play out in a way that you're not seeing in all countries around the world. But it's a really good sign of just how digitally enabled we are now. If you're a fintech or other a neobank or a challenger bank, it's not all good because your revenue model is based on people going out and using your card or traveling, basically making money on interchange when you're traveling. And that's obviously all dead for now. The other reason that people haven't rushed to their bank to take cash out is, and this is a really good sign of trust coming back in the industry, the amount of capital and balance sheet strength the banks have is significantly higher than it used to be. And you can see this in the chart that you just put up. This is, for those who are not bank analysts, what this chart shows you is the amount of capital on a bank balance sheet. So this ratio is called the CET1 ratio, which is the Common Equity Tier 1 ratio. It measures the amount of capital you have on the balance sheet relative to a risk-weighted measure of assets. So it's not your assets, but a risk-weighted measure of assets. And you can see the chart basically the bar chart is doubled. So the amount of capital banks have is doubled. So banks, there's two things. One is people, counterparties, consumers, other companies, not so worried about having money in the bank. Back in 2008, you'll remember people would, very senior fund managers I knew went and basically pulled money out of banks and put it in bearer bonds because they were so scared about the financial system. It also means that when it comes to management thinking, when it comes to excos and senior management, they have some bandwidth to think about, how do I accelerate my cloud project? How do I accelerate, investment in digital payments? They're not just thinking about balance sheet, which is what happened to some extent in March this year, but it lasted a long time in the previous economic and financial crisis. People were just focused on balance sheet because it was life and death for the banking industry. This time around, the banking industry is positioned to be an enabler for governments to help basically get aid, get support packages out. Now, there's an issue about how efficient or effective that is being, and we can talk about that in Q&A. A lot of these government packages, because a lot of the governments and all the banks are clearly not digitally native in the UK, in continental Europe, and there's a struggle to get this money out.
Ronit, can I interrupt you for a question?
Sure.
Because you're saying we're in a different type of recession,
Yeah.
Where banks are in a much stronger position than in 2008, for example. At the same time, this is quite a severe crisis, also. So what do you see as reactions of banks in that situation where they're quite strong, but very, very, in a strong crisis? And do you see different reactions in different parts of the world?
Yeah, there are different reactions. Partly because, back in 2008, e-commerce and online payments, digital payments were still relatively small. They were nascent. Today, they're so much of our transactions are online anyway. And now with COVID and most of us locked at home in half the world, everything is online. So if you don't, you're not a bank, but say you're a retailer. You're a retailer and you don't have a good online proposition, you're losing business to your competitors who do have a good online proposition. And it's somewhat similar for the banks as well. This is not in this. As soon as you've got to always think about the balance sheet to stay alive. But once you've said, okay, I've got enough funding, I've got enough liquidity, I've worked it out with the central bank, then you've got to think about, okay, how do I stay in business? How do I support my clients? How do I grow my business? And that's going to be a difference, particularly in Europe and the US this time around. That European banks and US banks are growing their balance sheet. So in a normal crisis, you have a credit crunch. And as the term suggests, it's literally a crunch. Banks stop lending. Banks say, I don't want to lend. It's too risky, right? Now, if you look at the US, in Q1, do you know how much bank balance sheets expanded, Hui?
No, I don't. Shall we ask the
Let's
audience?
ask the audience.
Let's ask
How
the
much
audience.
did corporate lending expand in Q1?
In the first quarter?
Yeah, in the first quarter of the year. 15%.
Okay.
Is that bank balance sheets, Dan, or is that corporate lending? 20%, 200%.
I would have said minus something, but apparently
bank balance sheets went up about just over 10% in Q1, and lending for corporates grew 20% in Q1 in the US, and it all happened in March because what happened is corporates saw what was happening in the economy with the lockdown. So the corporates basically approached the banks and said, I want to draw down on my credit lines. And that led to a temporary, for a week or two, quite a dislocation in financial markets. And that's when the Fed came in and said, we'll buy everything, junk bonds, whatever. So bank balance sheets shot up in Q1. Now, you're not going to see that in Europe yet, because Europe doesn't have so many undrawn credit lines. But you're going to see that to some extent in Q2, in a smaller way. You'll see that in Q2, because like with the UK package to support small business, the Italian, the French, most of these packages go through the banking industry. Now, many of them have teething problems. I think the Swiss and the German packages have worked well. The other packages have teething problems. But as they work through April and May, it's banks who will be doing the lending, and the government is guaranteeing the lending. Now, the banks can do the lending because effectively the central banks are standing behind them saying, whatever liquidity you want, we're going to give you. So banks are in a very different mindset. And I'm talking specifically about big banks. Now, if you go to all over the world, particularly when you come to, so I'm sitting here calling you from Dubai today, dialing in from Dubai. A lot of banks are announcing their first quarter numbers and saying, we have to focus on costs. We have to reduce our cost base. We have to think about efficiencies, and so there will be that as well, Aman. And so if you're a vendor to a bank, you're a fintech, you might find that in the next few weeks or even the next few months, things from the outside look really slow, that you can't get as much communication or speed from the bank. But actually, depending on the bank, in particular the larger banks, there's a lot of rethinking going on. There are a lot of projects being decided now. As I said, projects about how much do we rely on the cloud, projects about how much real estate space do we need. So there are a lot of decisions being taken, which will be quite fundamental as we go through in the next few quarters. Now, one other point to mention is the global banks, and many of the global banks have actually come out and said, and this is quite significant compared to previous crisis, we're not laying off staff. In fact, many of the American banks have more for consumer bank employees and lower income workers. Many of the American banks have actually given bonuses, short-term discretionary payments to lower income staff in the consumer banks. The Americans in the US, but the banks, the global footprints like ourselves, those have been paid out or are being paid out across the world. So wherever you work, if you work in the UAE, you work in India, so it's a very big difference. The banks are saying, hey, we have to look after our staff. We have to protect our staff. You remember 2008, Hui? 2008 was about, brown boxes, people walking out of banks with cardboard boxes. So it's a very different crisis. Now, the GDP shock will be enormous, and we're all feeling it, or many people are feeling it right now. Many people are losing their jobs. You've seen the unemployment numbers for the US, but the economic policy response is also enormous. So there's these two enormous forces coming together, and the banks are in the middle.
And if we talk about fintech now, because you have different hats, one of yours on the fintech side. So we've had also an enormous growth of fintech over the last few years. So what do you think will happen now?
I think I think it depends on the size of fintech you are and the type of business you're doing. If you're a fintech that's really early stage, like when I talk to my friends who are in the kind of funding stage of A or seed, it's going to be challenging to raise funding compared to 3 or 6 months ago. Equally, if you're a large established player, strategic partners, whether they're the big credit card companies, the big tech companies, strategic partners have very deep pockets. If you take the big credit card companies or the biggest banks in the US, the market value of the biggest bank in the US is the same as the market value of all the Eurozone banks. It's huge. The market value, the equity market value, the stock market value, I'm not naming names, but you guys will have to work it out. But the stock market value of the biggest credit card company in the world, based out of the US, is the same as the Eurozone bank industry. So the amount of firepower, the size of these companies is, if you're a later stage fintech with a product that's been running for a few years with an established this B2B or B2C platform, there's plenty of, you will find funding. The problem is going to be for the early stage. And the other problem is going to be for business models that were based on, like I said before, you're an interchange-based business model, like a lot of neobanks in London are. If you're an interchange-based business model, and people are not going out as much, people are not traveling, and even when travel comes back later in this year, it won't be the same level. You better have raised funding recently.
So it seems like you're saying both for banks and also for fintech startups.
Yeah.
That's not going to be like 2008, where it's just going to be very, very bad, for everyone.
Yeah.
It seems like there's going to be very differentiated, kind of impacts depending on, for some of them that could be actually quite positive, whereas for others it could be really negative.
Oh, absolutely, yeah. I mean, the banks won't make a lot of profit in Q1 or in the first half of this year, but they're not going to be making losses or depleting their capital reserves. And that's the big difference. So the banks, as soon as they have a little bit of management sort of flexibility, right now the banks have been focused on, like many companies, on business continuity, just keeping the business going, right? But that in itself has again made the banks realize just how already in a way digital they are. They may not be digitally native, they're digital tourists, not digital natives. But as I said, most of my department very, very quickly went to working remotely. Actually, working remotely is a complicated concept. Let's just say working from home. Uh, but it happened. It happened very quickly. Our systems had a bit of strain, like everyone, but it was quite fast. And this will show to a lot of people in managerial or decision-making positions in banks that a lot of we're in the ultimate intangible industry, right? We can most of what we do can be done as long as we have a laptop or a phone and an internet connection. Most of what we do can be done. There's a little bit of, that's why I started with physical cash at the start of this conversation. There's a little bit of physical, you need to have, yeah, you need to have some physical cash around, but generally most of what we do is an intangible.
Yeah, Ronit, I realize there's a lot of questions actually. So let's get the questions. And if you'd like to ask questions, go to the Q&A part and upvote the questions, and we'll just take them in this order. So what fintech sector do you see emerging after this crisis in the same way as challenger banks emerged after 2008, 2009?
Sorry, can you repeat that, please, Hui?
So what fintech sector do you see emerging after this crisis in the same way as challenger banks emerged from 2008, 2009?
Right. Well, I think the biggest change that we've all lived through in the last month is anything to do with online payments, bill payments, online payments, e-commerce payments are growing at an exponential rate. So it's not like we don't need more challenger banks being launched in the UK. Like we have enough. In the Middle East, there aren't as many challenger. In fact, I think there's a challenger bank as a standalone challenger bank doesn't really exist. They're like challenger brand propositions. And many in the pipeline that are going to be launched, challenger brand propositions. But I don't know if we need more neobanks in the world. What we need is the way we're living was already changing and is being accelerated. This idea of basically being moored to an office, being moored to a physical space, commuting into the central business district or into wherever your workplace was. We've been moving to a more fluid and a more distributed workforce. And similarly, commerce is going to be more distributed. And anything to do with anything that kind of facilitates that. So right now, I mean, if you have an online payment gateway business already set up and running with clients, you're booming. Online payment gateways. You're an interchange-based, travel-based fintech. You got problems, right? So I think anything that kind of fits into helping us sort of in the post-COVID world, the kind of new world of working, how we're going to be working differently, living differently, anything that plugs into that is going to be really successful. The other area, like, I mean, right now, take the example of, in today's news, you probably saw in India, sort of one of the big American tech companies investing into other telcos. I mean, India is a really good case study right now of basically big tech. So not fintech or not really startups, but how big tech is becoming really relevant in payments. So look at, I mean, in the US, you get debates about whether or not Google or Facebook are going to be big in payments. COVID and the lockdown in India has further accelerated the growth of Google Pay. It's going to be, I don't know what the numbers are, 400 million users already. So actually some of the existing trends of big tech in emerging markets become, that's being entrenched. I mean, in the last pandemic, I mean, the roots of Ant Financial kind of came out of the B2C platform of Alibaba came out of SARS, right? And it was coincidence or causation, but that's where it came out of. In this pandemic, you'll see this across the world. You'll see this in India. You might see it, you've seen this in the Middle East, Africa as well. Some of these existing big digital platforms on the payment side are just going to get more and more entrenched into our lives.
No, I agree with you on payments, no, definitely. I think I would add also, and especially if we have some entrepreneurs in the room, I think there's a sector that I've liked for a long time, which is SME, and any services for SMEs, which we've started to see the trends over the last few years of challenger banks for SMEs in terms of companies that were providing invoice financing, etc. But I think the SME sector is a very, very big, I guess, victim of this crisis. We've seen some of the numbers. I think 60% of the companies in France have had to put their employees in furlough. A lot of them, which are very, very small companies.
Right.
So the digitalization of SME and of course the way they do finance, I think that's going to be one of the huge trends over the next few years. Another question that we have about regulation. Do you think that this crisis is going to help to open up government regulations for fintech companies?
I think this crisis is going to the enforced change of behavior that we've gone through is making regulators and senior managers realize in big institutions that maybe there were things we did just because of habit or tradition. And this creates opportunities for fintechs. So one big challenge in onboarding in a traditional bank is, it's manual. There's huge amounts of paper, right? And you have to do these stupid wet signatures. And then, if your signature doesn't match exactly, they make you do it again. And I remember when we onboarded, when I opened an account, a joint account with our wife, and her signature wasn't matching what was in her passport that she'd had like 7 or 10 years ago. And they kept making her do it over and over and over. And I think she signed the bloody application form for our joint account 10 times when we moved to Dubai. And I mean, what's wrong with e-signature if the regulator allows it, right? Or you probably saw the story on Bloomberg recently of a bond issue that a huge amount of bond issuance has taken place in the last couple of weeks. Many of the custodians require a wet signature of the banker doing it. You were in fixed income structure. I mean, basically, the lead banker, not at our bank, but another bank in New York, had to, he did the whole transaction from his home office, and then he had to get the documents, sign it, go to his local courier shop or whatever, and courier the documents to the custodian bank. I mean, and the more weeks and months we spend in lockdown, people are going to realize that there's all this kind of stupid. I mean, there's a lot of kind of inbuilt, stupidity in our system because of that's how we used to work. And so I think that a lot of this is going to change. And regulators will say, hey, we managed 3 months and the system didn't break. Everyone was working from home. Everyone was doing VCs. Everyone was, using digital signatures or some variation of digital signatures. And so that's going to open up a lot of opportunities for, we won't be immediate, but regulators, banks are, I was talking to a couple of banks, banker friends of mine in another big bank in Singapore earlier today. And, banks are sort of not just changing the way they're thinking, but they're going to the regulator and saying, hey, can we do this a different way? And the regulator's saying, let's talk about it, because otherwise everything would stop now. So it's forcing us to break habits that we were just doing because it was BAU. And that's a huge opportunity. If you have the cash and the ability to stay in business as a smaller fintech, that creates a huge opportunity for you down the road.
No, thanks a lot, Ronit. We have really little time and still a lot of questions. So shall we try to take, let's say 5 questions in the next 3 minutes?
Go on.
Okay. So next year's expenditure on digital transformation, do you think it's going to be more or less? For banks?
Over the next 3 to 5 years, it's going to be more. In the next 3 months, I don't know. But just to go back to what happened in 2008, 2008 to 2009, new projects spending was slowed. 2010, the US banks, the Canadian banks, the Australian banks all began to spend, and they saw a ramp up in their tech spending. May not have been digital per se, but their tech spending began to go up from about 2010, 11. So like all the cool stuff you do at the front end requires, like say a data lake at the back end, or now all of that hard work was being done early in 2010. In the European banks, in the Eurozone banks, tech budgets didn't go up till about 2015, 16. So you had like 5 or 6 years when tech budgets went down because bank managers focused on survival and balance sheet. It's going to be very different this time around because the banks know. I mean, if you're running a big European bank, you know that, if we let the Americans or the Australians or the Canadians or the Singaporeans or whoever spend more money, we're going to fall further behind. And then the big tech companies are going to take even more of our retail financial services wallet. So I think digital spending, there might be a pause temporarily, but it'll pick up pretty soon in these big companies.
Okay, thanks. Next question. The crisis has caused some corporates to accelerate their supply chain finance program. Do you think that early supplier payments via fintechs, I guess, invoice financing, for example, will be the new normal after the crisis?
Yeah, it's what I was saying before about how everything is, we're rethinking how everything we do. So that creates new opportunities. But in a lot of the world, supply chain, particularly once you get beyond the really high end, the big banks don't want to get involved. Once you get beyond like the $500 million, $1 billion type turnover, when you get to the smaller companies, there's still a lot of the supply chain which the big banks don't really want to touch. And that's definitely a big business opportunity. I mean, you and I both know many fintechs are trying to grow in that space.
Yeah, definitely. Next question. How is the crisis impacting the FICC part of banks, fixed income part of banks?
Sorry, how is the crisis affecting?
The wholesale, so a fixed income, FICC.
Oh, wow. In Q1, it was a mega quarter for fixed income. Most of the big banks, or at least the big American banks, have reported Q1 numbers. Revenues were up typically 30% year on year. The rates and the FX products were enormous in Q1 because there's a huge amount of client activity. Corporates, putting new hedges on, restructuring hedges, volumes picked up, but spreads blew out as well. And because of de-risking of the last crisis, the banks don't have as much proprietary risk, so they didn't lose as much money. So actually, Q1 was like a mega quarter on fixed income revenues. And I don't know if the Europeans will have the same. Some of the Europeans have already pre-announced that they'll have similar type of good first quarter numbers. But consumer credit card losses and anticipatory provisions for certain sectors in wholesale, like you can imagine airlines and so on, and oil and gas, that offset most of the monster fixed income quarter. There's a very good quarter in fixed income.
Okay, very good. And perhaps the last question, how is technology or fintech helping banks the most to provide the C-bills liquidity line? So basically the government if compared on banks' capabilities.
Yeah, and so this goes back to my earlier question, or my earlier comment about how, banks have done a lot on digital, but they're not digitally native, nor is the government. So the whole process has been much slower than it should have been or could have been if the banks and the government were much more digitally native. First thing they've done is, the first positive for the fintechs is they've broadened out the number of who's able to participate in C-bills. So some of the neobanks, some of the more P2P platforms, but also the independent SME neobanks have been allowed to take part. And a lot of the growth in the last 2 or 3 years in the smaller end of lending in the UK came from these platforms or these neobanks in the SME space. So the initial reaction was to go by the Treasury was to go to the big banks and say, big banks, help me. But they quickly realized, so one of the things is like, One of the good things in the UK is when it doesn't work the first time, and the same in the US, the draft one or draft two may not be great. And you and I did a call about this like almost 2 weeks ago. Draft one and draft two may not be great, but they iterate, they kind of learn very quickly. And so you're going to see more of this, whether it's in the UK or in Italy or in France. I think you're going to see many more iterations because SMEs are going to need help all the way through the second quarter. And the amount of money that's been dispersed is nothing so far in terms of billions of pounds or euros. So there's a way more money that needs to get out to the SMEs.
Okay, great. Thanks a lot, Ronit. It's been a pleasure to have you with us. Very, very insightful, as usual. I don't know if you can stay a bit, for the networking part. So we're gonna have 20 minutes of networking now.
Okay, thank you.
And, perhaps for some of the participants, to talk to you
Okay.
directly. So thanks a lot. And for you who are online, thanks a lot for being here.